Welcome to NewYorkTrue.com. Today we're going to spend 5 minutes with Benjamin Lawsky, New York State's Superintendent of Financial Services. The Department of Financial Services, which Superintendent Lawsky heads, was created under legislation proposed by Governor Cuomo in his first year, and it began operation in October 2011. The new Financial Services Department combined the Banking Department and the Insurance Department. Until the merger, each were separate departments regulating their respective industries, with the Banking Department in existence since 1851 and the Insurance Department in existence since 1859. The merger is a major step in financial regulation and will affect the banking and insurance industries for years and decades to come. In our conversation, Superintendent Lawsky discusses how the idea of a merged department came to be, how the merger has progressed, the current state of the banking and insurance industries, and how the future looks for the Department of Financial Services. I began our conversation by asking Superintendent Lawsky about what led to the creation of the department and how the combination has proceeded so far.
The Department of Financial Services is very much the brainchild of the governor. And the governor was the Attorney General during the financial crisis. And I think one of the reactions, I worked for him at the time, and one of the reactions he had to the financial crisis was at certain times our regulation and our regulators were divided and separated. And smart financial innovators and smart lawyers were at times able to exploit gaps between those regulators and those regulations. And that certain products that led to a lot of the problems we saw in the financial crisis were really not being regulated by anyone. I'll give you an example, credit default swaps. For many years, credit default swaps, as they grew, that market grew and grew and grew. There wasn't much oversight. Wasn't a security, so the SEC wasn't looking at it. Wasn't really an insurance product, so the insurance departments weren't looking at it. Wasn't a commodity, so the CFTC wasn't looking at it. And what the governor decided was, you know, we have this great insurance department and we have this great banking department in the state of New York. And if we combined them, gave them a little more power to be a more holistic regulator of the financial markets in New York, we could do two things. One is we would get rid of those gaps, hopefully entirely, but at least certainly mitigate the problems that those gaps create in regulation. And at the same time, help the industry thrive, because you'd have a single regulator looking out for that entire financial industry. And it's certainly a goal of the department. We want, and the governor wants, this industry in New York thriving. It is so vital to our state in so many ways. We want to keep New York the financial center of the universe, and we're going to keep doing that.
And so 18 months ago, the law is in place, the departments formally merge, and how did you see it at that point in terms of how to make the merger happen, and walk us forward, if you can, a little bit from day one of the department to where we are now?
Sure. I mean, it was a very difficult process. We had to do a lot of different things. You have two departments with two different personalities, two different missions, two different sets of people, two different cultures. We also had two separate buildings, two different facilities. You're in the banking building right now, but the insurance building, which I know you've been to, is only a few blocks away. And we felt very strongly right away that we weren't really going to be able to make these cultures meld until we were all co-located in one building. And that's something that's taken a while, and it's actually a process 18 months later that is just about complete. But it took that long. We had to get a new lease. We had to move in. People are moving, and it's finally happening now. Other than that, there are parts of banking and parts of insurance that are easy to meld together, and there are parts of them that are not. And one thing we didn't want to do during the merger was try to force a marriage in places where it just wasn't going to work. So, for example, the examiners who look at insurance companies and the examiners who go into the books of banks, to some extent, do different things. And it's very hard to have a single person who can do both.
Well, let's talk about that, because to a layman, they think big financial institution, you need to walk in, look at the books, and why can't one who's skilled on one side easily flip over to the other? Yeah,
they're very much different types of, they're different firms. And look, are there people who have the skill sets to do both? Sure, but they're few and far between. Banks keep their books one way, their business models are different, they do different types of lending, Insurance companies, it's a whole different model of what they do. The way money flows in and out and the risks they take and how they manage their books and their capital levels are entirely different. So it would be very hard to be an expert at one and also be an expert at the other. So we've thought a lot about wherever we could find synergies, great. So for example, in our general counsel's office or in our admin division, we called it our Noah's Ark project. Everything we had two of, we wanted to have one of. So we had two IT departments, two law departments, two admin departments. Those we combined in the early months of the merger. It's been more complicated in the substantive areas, but we have a capital markets division which does a lot of different interesting things, and that's now combined. There are people from both banking and insurance in it. We have a real estate finance department that does a lot of mortgage work, but also a lot of title insurance work, and that's a combined insurance banking unit. So what we've tried to do is, where the synergies work, really merge there and do it in a smart, innovative way and get all the bang for the buck we can there. But also in other areas, don't force the issue. You know, you can't make a cat a dog.
And in the areas where you so far have not tried to make a cat a dog, do you think that that's really a long-term, the way that you'll be long-term, or do you think there's still likely to be mergers in those areas, substantive mergers in those areas? So where in the process are you figuring that out? It's
a great question. I think we'll continue to evolve over time, but I think before we did this merger, we studied, there were about 7 or 8 other states that had tried similar mergers. And to be honest, none of them have done it particularly well, truly merging the two. There are many places where you house both agencies together, but they're not really together. But truly merge like we are, it's been tried in other states, hasn't worked out that well. So we were very cautious. We didn't want to, again, merge things that just didn't make sense and try to force the issue. So I think we'll continue to evolve, but 10 years from now, I don't think we're going to have a group of people that examine both banks and insurance companies and look at their books. I think it's unrealistic just because the nature of those firms are so different. And that wasn't really a goal of the merger, frankly. Again, the merger was about trying to get at those gap products and just trying to be this a regulator that is more holistic in looking at the markets. We saw it with Sandy, you know, which I know we'll talk about in a few minutes, but we initially had an insurance problem we were dealing with right after the storm, and it evolved into a banking problem. We've recently been dealing with an issue called force-placed insurance, which we don't have time to get into, but that is that issue is a combined insurance banking issue. It's right in the sweet spot of why DFS was created. So we try to, again, get the advantages we can where it makes sense and be a better regulator that way, but also not try and be something we can't be.
And with the department pretty well molded now, although as you said, still some pieces to finish off, and 18 months of covering both substantive business areas, what do you see in terms of those regulated companies and their development or evolution? Are they evolving particularly quickly into different forms that they've been, or are they still more or less separated insurance banking with some overlap, but really still a distinct center of gravity?
Yeah, it's very interesting because the two industries are in much different places right now. The banking industry is still reeling from the financial crisis. And more than reeling from the financial crisis, they're reeling from the regulatory process that took place after the financial crisis. And so banking is in a much different place, and I think it still remains to be seen, you know, whether the big banks, exactly what model they end up taking, what we do about too big to fail banks, and what we do about the smaller community banks, especially the 70 banks upstate New York, which play a vital role in their individual communities. And what's their business model going to be with all this new regulation coming out? Much of it, because of the financial crisis and the 6 or 7 big banks that caused the financial crisis, but also hitting these smaller banks and causing them a lot of compliance issues and a lot of costs, and maybe causing many of them to merge just to have some scale to deal with these new costs. So there's a lot of tumult right now in the banking industry, and we'll have to sort of wait to be seen. It'll have to wait to be seen where it ends up. The insurance industry, is fairly stable right now. And it is interesting being an insurance regulator and a banking regulator all at the same time, because we learn lessons from the one side of the house that often are helpful on the other side of the house, and then vice versa. And with the insurance industry right now, for example, there's a big movement to go to what's called principles-based reserving. And this is a form of reserving where right now we, the regulators, tell them how much capital to hold with pretty strict guidelines and rules, working that out based on their book of business. The industry very much wants to go to what's called principles-based reserving, which will bring their reserves levels way down, and it's based on their own internal modeling. It's something that was done for the banks during the Basel II process 10 years ago, and the companies, it was fought by Sheila Bair, and the companies that did go to a principles-based reserving model on the banking side ended up being devastated when the financial crisis came, because they had moved their reserves from around 8% to down to 2%. And when it came time, when things got bad, they just didn't have the capital, many of them, to survive. So we've really learned a lot of lessons from that. And so New York has been very outspoken against this move on the insurance side to go to that principles-based reserving levels. And it's something that is still being fought out.
Well, on that topic, the insurance industry certainly is filled with very smart, very experienced people, especially at the top, who undoubtedly saw what happened in the banking industry. And why do you think, still being so close to the financial crisis, what motivates the insurance industry to do that, or why do they think it will work for them where it didn't work so well?
Yeah, look, I think they have certain arguments which are valid, which are surrounding the idea that insurance companies are not exactly like banks. They're not as interconnected. You don't usually have a run on an insurance company like you could have a run on a bank. So there are certain distinctions. Nevertheless, bringing capital levels down, especially in a time that we are in right now of a long-term low interest rate environment, is very dangerous in the insurance industry, because they really rely on those interest rates being a little higher. And so I think that's part of it. And I think the other part of it is this was a project in the insurance industry that was begun pre-financial crisis. And like everything in life, people get wedded to this idea, a lot of resources get put behind it, and they want to still move forward with it. We think it's a very dangerous thing, and we're being pretty outspoken about it, and we'll see how it shakes out.
And looking at, again, the merger now 18 months in, does it look to you like there is a need for further major changes in the financial services law, whether expanding it or changing it in some way now that you have a year and a half of experience under your belt and the department's belt?
That's a good question. It's funny. We still, if I can speak for the agency, we still feel very young, and we're still, in a way, finding our way. We've got a lot of very interesting projects. We've had a bunch of very successful initiatives, but I don't want to jump the gun and say, we need to change the law here, here, and here just yet. The financial services law we did do that brought DFS into existence. I think a lot of time was and a lot of negotiation was put into it, and I'm not anxious to reopen it just yet. I think we need a couple more years maybe of experience understanding what we're doing right, what we're doing wrong, where we could use a little more power, or maybe use a little less depending on the situation. So I think the jury's still out on that one.